Look, forget the 20-year Mars colonization roadmap for a second. Forget the endless debates about reusable rockets. If you are actively trading this market right now, today, June 16, 2026, you absolutely must understand the raw, aggressive market mechanics driving the most explosive IPO in financial history. We're not looking 10 years out. We're looking at tomorrow, next week, and the next quarter. We're going to tear down the momentum, the sentiment, the options flow, and the exact catalyst calendar that is dictating the price of SpaceX stock right this very second. Hit the ground running with this sheer staggering number. Just a few days ago, on June 12th, SpaceX went public. They raised $75 billion out of fixed $135 a share. That gave them an initial valuation of $1.77 trillion. Boom. Instantly the largest public offering on record. But the stock didn't stop there, right? It popped 19% on day one and has just gone parabolic ever since. It rocketed past $190 a share, completely blowing past that $2.5 trillion valuation mark. The tape is literally acting like wildfire. So the question every single trader is asking right now is, why? What is actually fueling this? Well, the core objective of what we're breaking down today is to separate the long-term fundamental investor narrative from the immediate mechanical reality of short-term swing trading. You see, long-term investors, they're sweating about whether a 100-plus price-to-sales multiple is sustainable. But if you're a swing trader, valuation is totally secondary to flow. We really need to understand exactly how long this structural buying pressure can overpower the fundamental gravity of the company's actual, real-world revenue. To really grasp the current market situation, you have to consider the blast radius. The SpaceX IPO is acting like a massive financial black hole right now, triggering what analysts are calling the siphon effect. While SpaceX shares are up roughly 40% since the IPO, adjacent space stocks are getting absolutely crushed. Rocket Lab is down 13%, Virgin Galactic plunging 37%. Institutions and retail traders alike are just liquidating their peripheral space holdings to free up capital so they can chase the marquee player. Capital isn't just entering the space sector, it is aggressively rotating directly into SPX. It's wild to watch.
And the market sentiment? It is absolute, unfiltered euphoria. Just listen to this quote from Wall Street Bets. It perfectly captures the retail mindset right now. They're saying SpaceX is Bitcoin and everything else is just a lesser coin. Retail sentiment trackers are showing a massive, dominant 61% bull rating for the stock. This isn't just about investing in a company anymore. It's a structural FOMO event. Retail traders were locked out of SpaceX for 2 whole decades while it was private. Now, they're finally getting their chance, and they are buying with both hands.
So who exactly is creating all this insatiable demand? Let's break it down. First up, massive institutional accumulation. Cathie Wood's ARK Invest went absolutely all in, buying $530 million worth of SpaceX stock across 4 of its ETFs on day one alone. Then you've got the retail FOMO, which is being driven by participating brokers who allocated a massive 30% of the float to retail. You want to know the real accelerant? Synthetic flows. ProShares just dropped a 200% daily leveraged ETF for SpaceX, and because that fund has to rebalance daily, it is literally forced to buy into strength, mathematically amplifying the stock's intraday upside. Oh, and behind all of that, active funds are front-running a massive wave of passive index buying that's about to hit. Now consider the other side of the equation. We have a severe supply vacuum. Think about it. You have historically unprecedented demand chasing an artificially starved public float of just 4%. Elon Musk, the insiders, major institutional backers like Alphabet, they are holding the vast majority of the equity. And to make things even tighter, retail brokers actually implemented strict anti-flipping rules. They essentially warned retail investors that if they quickly sold their IPO shares, it would hurt their eligibility for future offerings. So that completely locked up the retail supply. It created this acute imbalance where demand is incredibly urgent, but inventory is practically non-existent. And that brings us to today, June 16th. Standard options contracts on SpaceX officially begin trading. Pre-IPO futures already priced SpaceX at a heavy premium, which means all this pent-up speculative capital is just flooding the derivatives market right now. Here's how this plays out. Retail floods in to buy out-of-the-money call options. Market makers take the other side of that trade. But to hedge their risk, to delta hedge, those dealers are forced to buy the underlying SPX stock. In an environment with only a 4% float, that forced dealer buying turns a rally into a vicious, self-reinforcing feedback loop. This is the exact pipeline for a massive gamma squeeze. For a swing trader, the timeline is literally everything. So let's run through your catalyst countdown. Today is the options launch, but look right ahead at late June and early July. FTSE, MSCI, and the NASDAQ 100 are all fast-tracking SpaceX into their major indexes. This is your immediate rocket fuel. However, As we look further out to the next quarter, the narrative starts to shift. September 2nd brings the first public earnings report, which is going to be the first real fundamental reality check. And then, looming out there in December 2026, is the expiration of the insider lockup period. That is the ultimate fundamental gravity well for this stock. To really put those index inclusions into perspective for you, analysts estimate that the Nasdaq 100 fast entry alone will trigger between $22 billion and $27 billion in forced passive buying. Just think about that for a second. We're talking about index tracking ETFs and mutual funds that are mechanically mandated to acquire SpaceX shares within roughly 15 trading days of the listing. They don't care about the price to sales ratio. They don't care if the stock is overbought on the RSI. They simply have to buy. That provides a massive price-agnostic bid directly underneath the market. All right, so let's transition into Section 1, the 30-day bull case, what we're calling escape velocity. If you are trading this from the long side right now, the structural argument backing your play actually has very little to do with rockets and absolutely everything to do with flow. It is that perfect combination of unprecedented fast-track index buying colliding with the scarcity premium of a tiny 4% float. Add in the ignition of the options gamma squeeze we just talked about, and it's no wonder momentum traders are confidently chasing technical upside targets of $220 to $260. The market absolutely loves a clean narrative. And right now, the narrative is mathematically undeniable. There are simply way more forced buyers than there are willing sellers. But we have to look at the other side. Let's pivot to Section 2, the 30-day bear case, or orbital decay. The fundamental gravity threatening a brutal pullback here is rooted in absolute valuation realities. At current prices, you're paying over 109 times trailing sales. Why? Well, because the February 2026 merger with Elon Musk's xAI essentially turned StarX from a highly profitable launch monopoly into a cash-burning AI infrastructure play. SpaceX is deploying massive capital. We're talking a staggering $14 billion burn rate just to build orbital data centers. So those profitable Starlink revenues, they're actively subsidizing this massive AI war. This extreme capital intensity is exactly why Morningstar just slapped a deeply bearish $63 fair value target on the stock. They're warning that the price is moving much faster than the actual business underneath it. And historically, megacap IPOs of this nature follow a pretty predictable trajectory. The initial IPO pop is almost always driven by retail entering the market and pure, unadulterated hype. But eventually, that hype unwinds. The stock often enters this dead money phase, trading sideways or even down for a year, maybe up to 4 years, as the actual fundamentals finally catch up to the sky-high valuation. It's only after that hype is totally flushed out and true institutional convexity builds that we see the real move. As swing traders, we must be highly aware of whether we're riding the initial hype spike or about to get trapped in the unwind. Let's break this down into objective probabilities for the active trader over the next 90 days. Over the next week, it is highly bullish. The momentum from options launches and imminent index front-running is just way too strong to fight right now. Over the next month, though, expect extreme high whipsaw volatility. That index buying will begin to taper off, and the market is going to aggressively try to digest that massive 130x price-to-sales multiple. Over a 3-month horizon, the probability definitely shifts to bearish, with severe correction risk. As we approach those September reality check earnings, and the market starts looking forward to that massive December insider lockup expiration, the upside momentum is highly likely to fail. So the crucial point here is understanding the dichotomy of this specific moment in the market. The trader's reality and the investor's reality are not the same thing. The short-term trader is absolutely justified in buying the momentum, capitalizing on the flow scarcity, and riding that options gamma. But the long-term investor view, they are waiting. They see the valuation gravity. They're monitoring the xAI cash burn, and they are preparing for the immense supply shock of the December lockup cliffs. Because riding a mechanical one-week squeeze is an entirely different game than holding a structurally overvalued asset for a decade. So, as we wrap this up, you need to clearly define your strategy. The market mechanics are clear, the catalysts are laid out, and the structural risks are glaring. Look at your portfolio, look at your time horizon, and ask yourself right now, are you actively managing your risk to ride the short-term liquidity squeeze, or are you blindly holding on, completely exposed to the impending fundamental cliff? You have to decide what kind of market participant you are today, because with a stock moving this fast, indecision is the absolute most expensive position you can take.